Bitcoin isn't collapsing, it's consolidating. The silence in this market isn't the sound of failure, it's the sound of transition. For years, Bitcoin has been a battleground between believers and skeptics, between decentralization and control, between chaos and order. Now it's entering a new phase, a quieter, slower, but far more consequential chapter, one that macro investor Jordi Visser calls Bitcoin's Silent IPO. It's the moment when early believers finally cash out, when the torch passes from the cypherpunks to the institutions. And if you understand traditional markets, this period will look familiar. After every successful IPO, there's a period of digestion. Early shareholders distribute their holdings, new buyers accumulate, volatility cools, sentiment drops, and the impatient start to wonder if the story is over right before the next wave begins.
Beginning in May and in early July, there were a lot of I want to say rumors flying around, but they weren't just rumors. And this is not speculation. Anyone can go look this up. But there were stories about China cracking down again on Bitcoin miners and on crypto ownership and blah, blah. And it got poo-pooed and everything went on. Since those stories came out, there's been an overhead of supply that have gone through. And I just want to make sure people realize there's two themes as a traditional finance person that has spent a lot of time trying to take the lens that I learned everything through, which was as a trader, as a macro person. So I think the reason I shake my head at Bitcoin is because every possible thing to everyone listening that you would want for Bitcoin is happening right now, meaning the government is supporting things. The financial guardrails are shifting. We've got news after news every single day about the financial guardrails becoming more digital economy. It's things that are necessary for the network effects to kick in. All of that has happened. We still see inflows from retail. We still see the banks now opening it up for people to go through. But there's clearly a bunch of whatever it is, OGs, Bitcoin miners out of China, whoever it is, large amounts. Mike Novogratz publicly said it. If you go back to July, there have been billions and billions of dollars of, let's say, original investors supporting Bitcoin, regardless of how you want to term it. So I'm writing a Substack. I think what people should think about is we don't have an IPO for Bitcoin, but this last 4 months to me feels like sourcing the pricing of the IPO, where the original investors are getting out of large chunks. Now, why is there ever an IPO? For monetization. If someone has 9 billion in Bitcoin, I think they should diversify a little bit. If it was related to China, guess what China has now that they haven't had since 2014, 15? A bull market in stocks. Guess what else people have? Well, they have the chance to invest in AI. AI is a 10-bagger in many cases. You've been able to do it in the public markets. So I think at some point, Bitcoin becomes a boring asset to people who are looking for 3-baggers, 4-baggers, 5-baggers. It becomes a diversification. So I think this is just a distribution of a few massive holders. And the weaknesses I have heard about Bitcoin as I've gotten into it from institutions, it's too volatile. Not too volatile anymore. We've taken the implied volatility and the actual realized volatility down to 30 and below in some cases. So the vols come down. Okay, what's the next thing? Well, it's too concentrated in ownership. I mean, I've gone through the numbers. When you add Satoshi's wallet, you add the other whales, you're talking about a third of it has been owned by not many people. I think like 10,000 is the number I heard. Regardless of what the right answer is, every month the Bitcoin IBIT outstanding shares goes up. It's up again this month, even though the price is down. So I think everyone that's depressed has actually become entitled. I think they think it's a risk asset. Oh, there's another one. This is just a risk asset. Okay, well, it's not going up with the NASDAQ, so that's good. Lower correlation. Well, it's just digital gold. Well, it's not going up with gold. So guess what? In portfolio theory, for everyone who hasn't bought any yet, I think with your stocks, with your gold, with your bonds, now there's every argument to make. It's lower volatility now, lower correlation with the other traditional asset class, diversification from gold. I think this thing is going to move higher. I was wrong about where I thought we'd be at this point. It's still up for the year. I think once this consolidation is done and we're through the IPO process and the fundamentals take over, next year, once we get through clarity and the beginning of tokenization and the stories of Zelle and everything along those lines, I think we're going to have an acceleration. And
Visser's point is simple. This isn't capitulation, it's rotation. The long-time holders, the miners, the OG whales, the entities that survived the Mt. Gox era, finally have liquidity deep enough to exit without breaking the market. ETFs, corporate treasuries, and sovereign buyers have created the bid they were waiting for. Every coin that moves from a concentrated wallet to a diversified ETF strengthens the network's structure. Concentration is fragile. Distribution is anti-fragile. 1 million small holders are harder to shake than 10 whales. So while the community scrolls through charts and memes wondering why Bitcoin refuses to follow tech stocks higher, the answer sits quietly in market microstructure. The sellers aren't scared, they're satisfied. They're taking victory laps in silence. It's not a bear market, it's the end of the beginning, as Jordi says. The OG whales finally earned their liquidity event, and what they're leaving behind is an asset ready for the next decade. Less volatile, more institutional, and finally capable of absorbing real capital. Macro policy is the backdrop to every asset re-rating, and this one is no different. As Bitcoin transitions, the world around it is shifting from tightening to easing. The Fed's latest rate cut didn't shock anyone, but it confirmed what Visser has been saying for months. Liquidity is quietly coming back.
I think the fact that this happened, and there's two events that people have to pay attention to next year that to me are why this is absolutely positively a bullish thing. And I'll go to a third point that is the thing I've been talking to people about. Jordi, what would change your mind? Like you think the AI thing is a certainty. What would change your mind? And I'll get into that to end. So it is, Trump is supposed to go to China next year. And they've talked about April, they've talked about March, but the reality is this is stage one, meaning they're not going to hammer out some long-term agreement, but to get a truce is a big deal. If he's going to go there, that's a big deal. Here's the thing that I would say that they both know, which is the reason why I think China went all in on their provocation and then Trump anteed up. We have the midterms next year. Mm-hmm. If the goal for him was to shake this thing and get the tariffs done this year so that he could have a ramping into the midterms, I think that's really important. And I think that is something that people have to keep in their mind. I think there's a reality that waiting for 1 year takes us, just before the midterms. By then, we'll already have this stuff out. So I think his goal, and I think the entire administration's goal, is to make sure that the farmers are taken care of. Basically, his base is taken care of. But then also, because of the job market that is on the weaker side and the talk of writing checks to people, housing crisis, this is going to be the focus coming out. So for everyone kind of paying attention at this point, I think you could take that between China and the US, now the focus is going to shift from Trump away from these global issues, is going to shift on the domestic policy side. That's one side. And then on the other side, I think the fact that China's not invading Taiwan. Mm-hmm. And again, that's what people have said. What would change your mind? It's the perfect time. You've restricted rare earth. The military munitions are down. It's the perfect time if you were going to ever invade Taiwan. Doesn't mean they won't do it at some point in the future, according to every, geopolitical expert on the region. But for now, for people that are trading the market, I think taking that off the table and having a truce is a very positive sign, because it means the market can fixate on, hey, rates are moving lower. Inflation's coming lower. Gas at the pump is down to $3 and earnings are growing rapidly and profit margins are still expanding.
When rates fall and trade tensions cool, smaller businesses breathe, credit spreads tighten, and risk assets find oxygen. The truce between the US and China takes the tail risk of escalation off the table. It's not a final peace deal. It's a pause long enough for markets to reprice optimism. Visser ties it to the election calendar. The administration wants momentum into midterms. Lower gas prices, improving earnings, and expanding profit margins are the recipe. And in that environment, liquidity leaks everywhere, including crypto. But because Bitcoin's holder base is shifting, that liquidity doesn't show up as parabolic candles. It shows up as stability, as resilience, as the first signs that the world's most volatile asset is learning how to breathe in a normal market cycle. If policy is easing, why does every rally still feel like quicksand? Visser's answer: because the market's plumbing has changed. Retail traders now dominate short-term flow, armed with leverage, options, and social media dopamine. They front-run every headline, and when the instant moon doesn't arrive, they unwind just as fast.
All right, Jordi, I think we should start with the Fed cut and China trade announcement. First with the Fed cut, 25 basis points. Doesn't seem like that's a big surprise to anyone, but maybe the commentary around the interest rate cut was actually the more interesting part of this. What was your read on Powell's comments?
So I think we haven't had any labor data. Mm-hmm. So when you don't have any data, I kind of agree that it's hard to say for sure if December is going to be a cut. Let's assume that we come back and all of a sudden we've created 400,000 jobs. They're not cutting rates. I don't think that's going to happen, obviously, but I think that's the reason why. So I don't see it as a big thing. I do think I heard a podcast this morning from the Forward Guidance guys, and they made a really good point about retail, which we talk a lot about. So if retail's been dominating the action and they've been the buyers, they're also massive call option buyers. It's becoming apparent, and these guys brought this up, that the market structure has gotten to the point that I think when we have these events, especially when they all happen in the same week, so you had China, you had the Fed, you had the Mag 7 earnings, I think a lot of call options were purchased on the hope that this would all lead to an immediate move higher. Mm-hmm. And when that doesn't happen, they sell out of their call options. The banks need to get out of the delta that they've been using to hedge that. And it ends up as a sell the event thing. So I'm starting to believe that we're going to see more and more of this going forward, that when you have these weeks where there's this known catalyst, it's almost always going to be a sell the news event. So that's the way I would treat. They still have 70% chance of a cut in December, because I believe even more strongly than what we've talked about based on the news that's happened with Amazon and with UPS, that people are underestimating the labor market weakness that is going to be there. Not how bad it's going to be in terms of losses, but just this overhang and the need for companies to reduce people, replace them with digital employees. I've got more and more signs of that this week. So I would treat the Fed as just a sell the news event. China ended up being a sell the news event, but when you put them all together, the facts are they're cutting rates, which is going to help small cap businesses. It's going to help everything in terms of lowering rates. There's more probably to come if the labor market's there. And the China-US thing is kind of the end of this whole tariff thing. We won't really hear about it again because we have a truce for at least a year.
What we're witnessing is a generation of investors conditioned to chase catalysts and an options market forced to hedge their emotions. When calls are bought, dealers hedge long. When the catalyst disappoints, those hedges unwind. The result? A sell the news reflex, even in bullish environments. That reflex is masking the deeper shift. The Fed is easing, China is stable, AI productivity is deflationary, and transfer payments keep households afloat. Underneath the short-term noise, liquidity is improving, but traders are too busy reacting to notice. This is why Bitcoin's consolidation feels unnatural. Every macro signal says risk on, yet the chart says wait, because the real movement isn't in price, it's in ownership. The silent IPO is absorbing liquidity that would have otherwise exploded upward. While old money exits and new money accumulates, the rails of the system itself are being rebuilt. Every swipe of a card, every delayed wire, every settlement lag, all of it is friction, and that friction is profit for the intermediaries who sit in the middle. Visser calls it the VIG, and it's about to vanish.
Bitcoin was like, I almost think of it like Bitcoin was the main show. Maybe you had people stuck around for like the after show, but Bitcoin was the main show. People showed up, they watched, and they went home. Now there's like 20 stages and people are looking at all the different stages, and Bitcoin has some attention, but not everything.
Okay. We're at a very important point where let's leave Bitcoin over here and I'll get to it at the end. We haven't really talked about this, but I want to make sure everyone realizes that when you go into a coffee shop and you take out your credit card and you pay for your coffee and you leave, the coffee shop makes money, and that's fair. Like they brought you a service, but the credit card company makes money. And if you have your money in JP Morgan, or Bank of America, or any of the big banks, guess what? They're also making money. And the reason they've made money is because of the float on the money that you have, meaning you've got money in there, and unless it's in a money market fund, they're investing the money you have. They're giving you almost no interest, if zero. So everyone makes money constantly on the friction. If you're slightly late on a payment, or if whatever, okay, now there's a massive penalty charge. If you do a wire, massive penalty. As everyone is hearing the stablecoin thing and they're going through this, we are at the beginning of the disruption to the biggest friction there is in all of our life and all companies' lives. The float on an Uber driver, when they get paid from the time that you pay, who has that money until the Uber driver gets paid in 2 weeks, 3 weeks, whatever? Everything will be instantaneous. You take an Uber drive, stable coins are paid, they get their share, the company gets their share. All of a sudden, all the friction, the taxes, the VIG, it's literally just a VIG. So when you mention Coinbase and you mention all this, the financials, the banks and all this, they are racing with stuff like Zelle. They want to keep control of this VIG. Even if it's a smaller VIG, they want the VIG. And so you're going to see this race on all of this stuff. And so what it's doing is it's speeding up the process. This is the network effects taking off. So they don't want to lose to Stripe. Walmart's saying they're going to do it. Shopify is going to do it. Everyone's going to issue a stablecoin. Everyone's going to do this. So to your point, there's kind of a bubble feel. It's an ICO feel. It's all going on. But the reality is the government just opened up the regulations and said everyone can participate in this. Okay, well, that's going to speed up the process because everyone's racing for the profits that are available. They're not saying, I'm going to go slow on this anymore. And banks would slow everything. They already lost that fight, and that was the Genius Act. Before that, they were the ones slowing down the process. So I think people have to remember that with something like Zelle or any of these places, the more money that moves into stablecoin, the analogy I've said to people are there are two casinos when you go to Vegas. One is this old 100-year casino, and the other one's this new shiny casino. Everyone who's been using the old casino, they still have nostalgia and memories, and they walk into it, and it's a dilapidated piece of garbage. But it's like, oh, I remember when my kid was born, and I was playing that slot and everything else. All the money's there. The chips are there. If all of a sudden, for some reason, they end up in that new shiny one and they test it out and they're like, whew, this place is beautiful. This is nice.
Smells nice.
Everything's good over here.
Food isn't stale.
You know how fast the chip stack is going to go from there to there and be converted in once you open it up. So I've always said the adoption for wallets is very difficult. Well, if the adoption for wallets is now presented by the banks,
Game
who
over.
you trust, it's over. And that's what's going to accelerate over the course of the next.
Stablecoins collapse the VIG. They settle instantly, cut out float, and root value peer-to-peer. Banks, payment networks, and fintechs will race to keep a fraction of that margin alive, issuing their own tokens just to stay relevant. This is the financial industry's version of the internet moment. Every institution wants to build its own wallet, its own chain, its own Zelle 2.0. But the net effect is the same. Money becomes software. Transactions become data. And liquidity flows 24 hours a day, 7 days a week. This is where AI and crypto begin to merge. AI agents will need digital wallets, on-chain identity, and programmable money to transact autonomously. Every new layer of automation increases the velocity of value transfer. Bitcoin sits above it all as the reserve layer, the store of value that anchors the new rails. Stablecoins handle the payments. AI handles the coordination. Together, they form the next global settlement system. Visser's thesis reframes what success looks like. The days of 100-to-1 returns are probably over, but that's the point. Bitcoin's future isn't in outsized speculation. It's a normalized integration. The halving narrative, the ETF approvals, the regulatory clarity, those were the milestones. The silent IPO is the digestion. What comes next is scale. As ownership fragments and volatility compresses, Bitcoin becomes easier to hold, easier to allocate, and harder to kill. Its role shifts from rebellion to reserve, from experiment to infrastructure. Patience is the trade. IPO distribution phases in traditional markets last 6 to 18 months. Bitcoin moves faster, but human psychology doesn't. Impatience is still the best signal of late-stage consolidation. Every sideways week frustrates retail and strengthens institutions. Every dormant whale that sells adds stability to the base. And every regulatory green light widens the pool of potential buyers waiting for the overhang to clear. What the community calls stagnation, macro investors call maturation. The volatility of Bitcoin's birth is giving way to the stability of its adulthood. When this phase ends, without warning, without a headline, the next rally won't be speculative mania. It will be structural repricing. The same pattern we've seen in every transformative technology once the early holders pass the torch. So while the sentiment feels dead, liquidity is returning. While traders look for a catalyst, distribution quietly finishes. And while the market scrolls for dopamine, Bitcoin graduates to its institutional era. The OGs are cashing out. The new class is buying in. The casino chips are moving from the old tables to the new ones. And when the doors finally reopen, it won't be the same game. It'll be a bigger one.